Hello, welcome back to the show. So in today's video, I'll be talking about why this was the most bought stock by your super investors this quarter. So in today's video, I'll be covering a few things. We'll be covering the most bought super investor stock, why Amazon still looks great today, Wall Street buys the top, as well as some questions that you guys have left me in the comment section below. So the most bought stock that I'm talking about is none other than Microsoft. Microsoft year to date is up around 9%, beating the market. And the current valuation is at around a 35 times earnings. It is currently now the greatest market cap stock in the stock market today. And this is what the super investors have been doing. They've been buying Microsoft. So you're seeing a lot of high quality funds over here like Triple Fund Partners. You're seeing Chris Hone buying into it as well, AKO Capital, Thomas Gaynor from Markel Group. All these different super investors, they're buying heavily into Microsoft. And I do agree with them. Microsoft presented quite a decent opportunity last quarter when it was at its 52-week low. So this is what Chris Hone has said about Microsoft's moat in his latest interview.
So let's take a company, Microsoft, okay, which we've invested in. And one of their barriers to entry is bundling, okay, or maybe because it creates a customer switching cost. What do I mean by this? So the Office franchise, which we're all familiar with, has many products in it. You know, your applications, word processing, Excel, your email, security, different things, and they sell it as a bundle. Yep, they don't disaggregate it. And when a new product or a potential competitor enters, they can add it to the bundle. So Zoom came out with video conferencing, and they could have potentially, added all the things Microsoft does to that. So Microsoft had to respond, and they launched Teams. And they were able to distribute it through the bundle, free to everybody. And even though Zoom, some people believe was a better product, or is a better product, Microsoft won that battle because they had the installed base, the incumbency, which we talked about, and high switching costs for because once people are using their Office software, they don't want to switch, and so people started using Teams. Okay, something given to you free. Why? Because it was good enough. Yeah, it didn't have to be the best if it's free.
So for Microsoft over here, their moat is their ability to basically bundle everything together. So if you were to look at the entire suite over here, they have the entire suite of products. So they have the Microsoft 365 over here, which makes up around 32% of their revenue. And then you have your personal computing as well as your cloud computing. All those portions as well, they make up a large proportion of Microsoft's revenue. And what Microsoft does best is they can bundle everything together. So although they don't have the best products out there, like what Chris Hone has said, Zoom's interface is probably better than Teams, but because Microsoft is able to bundle everything together and basically present a better proposition and a value proposition to its consumers, the consumers will just buy the bundle instead of buying like Zoom, for example. So for Microsoft over here, it's an incredibly high quality business that has high customer switching cost. And for Azure over here, it's the story for Microsoft as well. So this is Microsoft's story over time. And as you can see, the Azure's cloud revenue has re-accelerated already. So currently now, Azure is the highest growing cloud computing sector out of the three hyperscalers over here. And over time, the distributors will always win. Even if agentic AI comes out, only the companies that are able to distribute it will win. And Microsoft already has a large installed base using its products already, and it will likely be able to distribute it the best. Same for Google, same for Amazon. That's why I'm invested in all the three hyperscalers over here. And so Microsoft over here is a high quality business, and I think it's going to stay here for the next 10-20 years or so. I mean, if you're to look at the track record of Microsoft grew revenue in 2020 and 2022 as well, which was quite remarkable, even though those 2 years were down years in the stock market as well as the general economy as a whole. Microsoft was still able to grow revenue in those 2 years. So for Microsoft over here, it's a high quality compounder, although it's quite richly valued right now. I think there's more room to run for this one. So for Microsoft's headwinds, here are some of the headwinds that they're facing today. The main one will be just the capex spend. So capex overspend, similar to your telecom bust and your dot-com bubble, could lead to a lot of depreciation, which hurts their earnings in the next few years. So this is an article that I found online, and this is what it says. So there's exponential demand forecast, then it was internet traffic, now it's AI model demand. In the 90s, many genuinely believe every home would soon need massive bandwidth and that business would require unlimited data. True in the long run, but the timing was off by a decade or so. Could AI demand likewise take longer to materialize than the rosy projections suggest? So this article over here, what it's doing is basically highlighting the commonalities between your AI spend right now as well as your telecom spend back in the dot-com bubble over here. So this portion over here, what it's saying is that your capex spend is likely a lot more than what is already needed. Same for your telecom back then. And the other portions over here, he said cheap capital facilitating overbuild. The late 90s featured easy capital. IPOs, bond offerings, and loans were plentiful for any company with a fiber story. This led to less discipline in investment decisions, exactly what capital cycle theory wants. SoftBank's ability to marshal 100 billion for Stargate and the hyperscalers war chest are similar to what we saw back in the day for all those telecos. And then he continued on by saying that there is speculative access and reality check. So the telecom motto was, if we build the network, users for it will come. Killer applications did ultimately come, but not fast enough to save the over investors. One warning sign over here, Goldman Sachs points out that while big tech has ramped up capex to fuel generative AI, they have yet to show sustainable business models for this investment. So currently now we only have generative AI, we don't have your agentic AI yet, and that's the only use case that has been coming in so far. And as Aswath Damodaran has said, AI is going to stay here for the next 50 years or so, but the problem is there is no real implication, there's no real use case for it yet. And so if all these hyperscalers are pumping money into AI, then this could eventually lead to overspending. And then over here it says, overconfidence could hurt their business as well. The late 90s telcos executives were brimming with confidence. They were building the future highways and nothing seemed too expensive or too large scale. Mark Zuckerberg declared last year a year of efficiency in early 2023 has quickly shifted to effectively a year of inefficiency as he doubled AI capex. The desire to invest heavily to not be left behind even if it hurts financial efficiency is reminiscent of prior attitudes. So what he's saying here is that the CEOs are getting a little bit too overconfident, they're getting a bit too cocky, and what they're doing is they're trying to basically just invest and pump money so that they don't miss out, which is what Warren Buffett highlighted back then as well. He highlighted that CEOs will often tend to do things instead of just allocating capital into buybacks and doing dividends because they want to show some form of growth in the company and push the story. So for this article over here, I think this capex spend could be a problem in the future, but currently now we're still seeing it strongly in the numbers. The ROIC has been growing steadily, Azure is re-accelerating, and overall, I think until the numbers show, I won't be selling out of these stocks over here. As for Microsoft's valuation, so these are two of the valuations. So over here, this is Microsoft's current stock price. It is at around $450. So assuming a 28 times earnings for Microsoft and assuming a 14% EPS growth, which I think is doable for Microsoft, this company over here will give you around a 10% return. So currently now, Microsoft is around fair value, around $450 is around its current intrinsic value right now. And the point where I'll be looking into entering Microsoft again will be at around $380. I added back in April as well when the markets tanked. I was adding on the way down. I added at 380 as well as 350. My initial add was at a $400 range. So for Microsoft over here, if it drops to around $380, I think it will be a good time for you to enter into Microsoft, barring any serious economic downturn. Next portion over here, I'll be talking about Amazon stock. So Amazon stock year to date is down around 8%. Currently now it's trading at around a 33 times earnings, which is one of its lowest historical valuation. In fact, just a month ago when it was trading at 30 times earnings, that was the lowest valuation. So for Amazon over here, the worst case scenario is probably over already. The worst case scenario for Amazon was a prolonged trade war with China, given that the 50% of their third-party sellers are from China itself. So when a trade war was going on between China and US, that was why you saw Amazon stock dropping 10-20% almost every other day or so. And the stock is now arguably less uncertain and trading at a similar valuation before earnings and before Liberation Day. So before the earnings that they had in Q1 of this year and before Liberation Day, Amazon was trading at around a 33 times earnings, which is similar to the valuation that it's trading at today. So I think currently now Amazon is presenting quite a decent opportunity if you're a long-term investor. Of course, the better price was a month ago, but it is a decent bet now as well. So for Amazon over here, this is the story for Amazon. If you haven't seen this one yet, Amazon is introducing basically robots that can feel what it touches.
So the warehouse is 2.6 million square feet. It has 2,500 full and part-time employees.
Those employees are handling 3.5 million items every week here, with a lot of help from thousands of robots. Amazon says globally, robots help with 75% of all orders.
Amazon is one of the most advanced robot users in the world. Their robot warehouses are an astonishing thing.
There's some 5,000 robotic drive units here, ferrying packages around and tall yellow bins filled with items.
Instead of a human being going to get the product from the shelf comes to the human being.
So for Amazon over here, as you can see, Amazon is having a lot of use cases for all the robots, and once the robots come into play, like what Tesla is doing right now, Amazon will definitely be a beneficiary for it. So this has always been Amazon's strategy over the long term. They are always customers first, and they gain the largest market share, and that's what the consumers love as well. So they have so much brand loyalty, it's similar to Costco, and they can easily funnel everything to their Prime subscription and up the prices like what Costco does over here. So for Amazon over here, if you were to think about it, and if you were to look into their entire Amazon Prime subscription over here, it's just incredible. The price is so low, and yet what they offer is so much. They offer same day delivery, they offer your Amazon shows, they offer discounts and all that as well. So the value proposition for this one is incredible. I think they can double the prices and consumers won't hit back at them. So for Amazon over here, this is Amazon story. So AI spend is going to have a lot of use cases to increase margins. So like what we saw just now, there were the robots. So currently for the AI spend that Amazon is having today, they can funnel it to a lot of different use cases, including the robots that we saw earlier as well. And they can also do it for their AWS portion, which has its biggest customer being Amazon itself. So the margin expansion story is so strong, and there's a lot of runway for expansion given their margins are so low. If they expand their margins similar to what their peers are having, they could easily double their earnings. So this is how strong Amazon's story is. And for Amazon's valuation over here, as you can see, it's currently now trading at around $204 a share. So assuming a 28 times earnings for this stock and assuming a 15% EPS growth, Wall Street is projecting around 20% or so. This stock will give you around an 11% return. So the fair value right now for Amazon is around $210 a share. And the point where I'll start adding again to Amazon is around $180 a share, where you will get around a 14% CAGR for this stock over here. So I think Amazon right now, it's around fair value or so. If you're looking to buy this one for the long term, then I don't see any problem adding into this stock right now. But for me, I'll be waiting for lower prices to add into Amazon again. So next portion over here, I'll be talking about Wall Street's flip-flop. So this is Bank of America last month when we had the Liberation Day and all the tariff sell-off. So they say that Bank of America is pessimistic about stocks entering the year, has these fears even as tariff war dissipates. And then Bank of America won't sell the rebound in US stocks and dollar. And currently now we're only down 4% from all-time highs. And this is what they're saying right now. So they're saying that the S&P 500 could return to all-time highs again as sentiments improve. This is the exact bank releasing two conflicting statements just a month apart. So the boy who cries wolf will eventually get it right. Blocking out the noise is simply the better approach when it comes to investing over here. So instead of listening to all these different analysts, you should hold enough cash to make yourself feel comfortable at all times. Ignore the noise, sentiments always follow price. So last month when the stock was dropping every single day, when we're having 5% days, you were seeing all these analysts coming out and saying that, oh, you should sell the stock. And currently now when we're near all-time highs again, they're saying you should buy the stock. Instead, you should be doing the opposite. Market valuations now are high. The best time to buy was likely just a month ago already, and opportunities will likely come again with Trump's tariffs and this administration agenda over here. So don't feel the FOMO of buying into stocks right now. Of course, if you're comfortable holding them long term, it's okay for you to add right now. But currently now the tech valuations are relatively high, around the 30 times earnings, and the S&P 500 is now trading at around the 27 times earnings, which is historically one of the highest points. So I think if you're comfortable with your positions, you should hold off adding right now. The opportunities will come again. Last portion over here, I'll be talking about some questions that you guys have left me in the comment section below. So the first comment, it says, my cost basis for Baba is $180. I want to sell as I'm on the rate for the past 4 years. So for Alibaba over here, if you didn't know what happened, the stock crashed from around $300 a share all the way until $60 a share. And currently now it's trading at around $120 a share. So for Alibaba over here, if I were holding on to this stock, if my cost basis was at around $180, I don't think I'll be selling this stock, simply because Alibaba is undergoing some form of change over here. They're changing their business model from sort of like retail to more of like a diversified business model with AI revenue coming in as well. So for Baba over here, I think the intrinsic value will grow over time. My intrinsic value for Alibaba is around $130 a share. So of course I want it to drop a lot more for me to start a new position. But for Baba over here, given that it's undervalued today, I don't think I'll be selling the stock. Being in the rate doesn't warrant selling the stock. In fact, you shouldn't be basing off your decisions based on the stock being rate. Instead, decide whether or not you think the company can continue compounding over the next few years. I think I'm positive about Baba doing so if the Chinese government can cooperate and basically support all the tech companies over here. So if I had Baba at $180 a share, I don't think I'll be selling the stock. In fact, I would add on the way down as the stock continues to fall. Next comment over here, it says, my take on Google is that it's a good and strong company for sure, but the consumer behavioral changes is also a big risk. No one knows how disruptive AI can be to Google search. There are other companies to choose and they are not facing the same kind of uncertainty. So for me over here, I agree with this statement over here. People often underestimate the ability of disruption. So for example, Uber over here, maybe in the next few years or so, we could see automotive vehicles coming onto the streets already. And so for Google over here, no one knows how disruptive AI can be. I completely agree with that statement. It could be Google like this for a few years, and then suddenly at one instant, Google search could just vaporize all the way. So for Google over here, it is a company that is facing uncertainty right now, and that uncertainty could certainly turn into risk. And so I'm evaluating my Google position. I still deem it as extremely undervalued. My fair value for Google is at around $190 a share. Until it gets to around intrinsic value or so, I don't think I'll be selling out of this stock. Last comment over here, it says, who is your investor mentor, or where do you learn all this information from, if not from a mentor? So there are plenty of books online that you can search. In fact, I think from YouTube itself, there's this deem over here, it's called Aswath Damodaran. He has a lot of videos out there that you can learn from, and his valuation metrics and all that. In terms of where to find information, I think books are quite good. There's a Columbia University Warren Buffett book that impacted me when I was reading it, I think 1 or 2 years ago. It was quite incredible. That one completely changed my investor outlook and all that. As for my investment mentor, I do speak to people that are sort of like experienced with the markets, but I think books are quite informative when it comes to investing. If you want some book recommendations as well, I can leave it in the comments below. Thank you so much for watching this video. I hope you guys have found this one useful, and invest safe.